Hi, everyone. My name is Camila Farah, and I am the Partnerships Coordinator at CSAE. I'd like to welcome you all to today's webinar, which is hosted by Enkel. Enkel is a new CSAE partner, and they are experts in financial management for nonprofits. I'm very happy to introduce today's speaker, Omar Visram, co-founder and head of growth at Enkel. Omar, take it away.
Thank you, Camilla. We are so excited to be partnering with the CSAE. This is our first webinar with the CSAE, and really excited to be here with all of you and to share some insights on how you can improve financial management in your association. As mentioned, my name is Omar Visram, and I'm the co-founder and head of growth at Enkel. Since 2016, we've been helping NPOs and member-based associations manage their financial operations more efficiently. I'm excited to be here to share some practical strategies to help you navigate your organization's finances with confidence. But first, a few housekeeping items. A recording of this webinar will be sent to you by email after we are done today. There are some useful resources that we will share as well to help you start to implement some of the strategies that we discussed today. And finally, we will take your questions at the end, so feel free to drop them in throughout the session today at the bottom. Let me tell you a little bit about Enkel. We started Enkel in 2016 with a simple mission in mind: to help organizations like yours streamline and manage their financial operations more effectively. At Enkel, we serve over 300 clients across various sectors, and we're proud to support more than 100 NPOs and member-based associations. Our goal is to take the complexity out of financial operations and financial management so you can focus on driving impact for your members and stakeholders. Before we continue, I would like to take a moment to acknowledge the land where Enkel's offices are situated. We are on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. We are grateful to live and work on these lands, and we acknowledge the ongoing efforts towards reconciliation and respect for Indigenous peoples. So what do we do at Enkel? Specifically, our services are listed here: bookkeeping, payroll, accounts payable, accounts receivable, controllership, and CFO services. We dive deep with our clients and really get an understanding of their needs before we start working together. We then tailor a service offering to meet these needs using our best practices and top-tier technology to create a solution perfectly suited for each client. When you engage Enkel, you get a small team of experienced not-for-profit accounting experts who are focused on delivering these services to you. We remove the problem of becoming person-dependent that can leave an organization in a challenging situation when they have one team member overseeing all of these activities. Before we dive in, let's take a quick look at what you'll learn during today's session. Our goal is to equip you with the knowledge and tools needed to manage your organization's finances more effectively. First, we'll explore how to read and interpret financial statements with confidence. This will help you strengthen your financial knowledge and in turn better understand your organization's financial position, which will allow you to better communicate with your board and with stakeholders on this matter. Second, we'll highlight common red flags in financial statements that can signal potential risks so you can address issues before they become major problems. And finally, we'll cover key principles that will help you steer your association's finances in the right direction and, importantly, with greater confidence. I also want to share that I do not believe that this webinar will solve all of your problems and make you an expert overnight. Financial education is an area where executives need to regularly check in. Please note that we will also be in attendance at the upcoming CSAE conference, where we will be presenting somewhat of a part 2 of this webinar, really helping association executives to strengthen their financial resilience in 2025. Let's talk about why financial literacy is so important for executive leaders, especially in the nonprofit sector. Many of you may feel that finance isn't your area of expertise, but understanding the basics is crucial for effectively leading your organization. So why does financial literacy matter? First of all, financial literacy is essential for nonprofit leaders because it equips you with the tools to oversee your organization's financial health. It allows you to understand, interpret, and question financial statements, ensuring your organization stays financially sound. Financial literacy helps you ensure that you are managing and dispersing funds responsibly, ensuring resources align with your organization's goals. Financial literacy allows you to spot opportunities to streamline systems, saving your team time and making financial information more accessible. Accurate, transparent reporting builds trust with both your team and board, enabling informed decision-making. Finally, it gives you access to reliable data, empowering you to lead your organization with confidence. Ultimately, the financial literacy is about more than numbers. It's about maintaining sustainability and accountability. Now let's look at the 3 key financial statements that every executive should be familiar with: the balance sheet, income statement, and cash flow statement. These are fundamental tools you will use to assess your organization's financial health and performance. First, let's cover the balance sheet. The balance sheet provides a snapshot of your organization's financial position at a point in time by outlining its assets, liabilities, and net assets at a specific point in time. This is essential for determining whether your organization is financially stable and able to meet its obligations. The balance sheet is divided into 3 main sections: assets, liabilities, and net assets. Assets represent everything your organization owns, such as cash, accounts receivable, or property. Liabilities represent everything your organization owes, things like loans or accounts payable. Net assets represent the net worth of the organization or the residual interest in the net assets after liabilities are settled. Net assets in your organization may be separated into restricted and unrestricted net assets. The balance sheet helps you assess whether your organization is financially stable. For example, are your assets greater than your liabilities? This statement will help you understand whether your organization can cover its debts and obligations, which is crucial for long-term financial health. Use the balance sheet regularly, especially when you need to assess solvency, make decisions, or present to the board. It's particularly useful for giving you a snapshot of your financial stability. Next is the income statement, also known as the profit and loss statement or the statement of operations. Going forward, we will refer to it as the income statement. This report tracks your organization's revenue, expenses, and net income or loss over a specific period, whether it's monthly, quarterly, or annually. The income statement is straightforward. It starts with your revenue, which includes everything your organization earns from memberships, events, and sponsorship. Then it deducts your expenses. These include costs related to running your organization, such as salaries, rent, and operational costs. The bottom line of the income statement is your net income or loss. If your revenues exceed your expenses, you have a surplus. If expenses are higher, you have a deficit. This statement helps you evaluate your organization's financial performance. It shows you whether you're running a profit or a deficit and allows you to make adjustments as needed to ensure financial sustainability. The income statement is useful for tracking performance over time and making decisions about budget allocations or expense management. It's crucial for understanding whether your organization is on track to meet its financial goals. The income statement ties to the balance sheet through the net result of excess of revenue over expenses or deficit if expenses exceed revenue. So over time, if you run a deficit, your balance sheet will weaken as you will show an accumulated deficit in net assets. If, on the other hand, you run a surplus, your balance sheet will get stronger as it will show an accumulated surplus in net assets. And finally, the cash flow statement. The cash flow statement is the third key financial report. It tracks the movement of cash in and out of your organization during a specific period. This report focuses on cash generated and spent rather than profits, which makes it crucial for assessing liquidity. The cash flow statement, to be clear, is not a cash flow forecast. Like the other two statements, it tells you what happened in your financial statements from a cash perspective in a historical fashion. It tells you how cash moved in the period that the financial statements relate to. Next, let's jump into financial statement red flags. It's important to recognize potential red flags in your financial statements. These include potential cash flow imbalances, revenue recognition errors, and maybe negative margins. Catching these early can help you prevent larger financial problems from developing. Let's address our first red flag, revenue recognition errors. One of the most common issues that we at Enkel see in financial reporting is revenue recognition errors. This happens when organizations record revenue at the wrong time, which can lead to inaccurate financial statements. This often happens as a result of recognizing revenue on a cash basis rather than when it is actually earned. To identify these errors, the key financial statement to focus on is the income statement. The income statement reflects your organization's revenues and expenses over a specific period. Check to make sure that revenue is being recognized over the period that the membership relates to or not, and not when the cash is received. If you're running a membership-based association, you should recognize membership dues monthly over the course of the membership period, not upfront when the payment is received or when the renewal takes place. Let's dive into our second financial statement red flag, inconsistent balance sheet items. Inconsistent balance sheet items can be a sign of underlying financial issues that need immediate attention. These inconsistencies often stem from accounting errors, delayed payments, or timing mismatches in recording transactions. The balance sheet is a key document to review when checking for inconsistencies. It provides a snapshot of your organization's financial position, listing assets, liabilities, and net assets at a specific point in time. Where and how do we find it? To spot inconsistencies, closely examine fluctuations in your assets and liabilities, particularly in accounts receivable and accounts payable. With respect to accounts receivable, if there's an unexpected jump in accounts receivable, it could indicate delayed collections or a growing number of overdue payments from your clients. This affects your cash flow and could signal that invoicing or follow-up processes need improvement. Accounts payable. Similarly, if accounts payable suddenly rises, it may mean that your organization is delaying payment to vendors, which could strain relationships and impact your ability to negotiate terms. This can also indicate potential liquidity issues if you're holding off on paying bills due to insufficient cash. Other assets and liabilities. Look for unusual movements in other assets or liabilities, such as property or deferred revenue. A drop in assets could suggest mismanagement, while a spike in liabilities could point to new obligations that weren't accounted for in your budget. Spotting these changes early allows you to address potential problems before they escalate. Regular reviews of the balance sheet will help you maintain a clear and accurate picture of your organization's financial health and ensure that your reporting is reliable. Our third red flag is large deficits or surpluses and what they might be telling you. Large deficits or surpluses can signal that your organization is not aligned with its financial goals. These significant deviations from your budget can either be a warning sign of poor financial management or an indication of missed opportunities for reinvestment. To identify and address these issues, the two key reports to review are the income statement and perhaps the budget versus actual report. The income statement shows the organization's performance over a specific period, while the budget versus actual report allows you to track how closely your financial outcomes align with your original projections. When reviewing these reports, compare your actual revenue and expenses to the budgeted figures. Look for significant deviations, whether in the form of large deficits where expenses far exceed revenue, or surpluses where actual revenue significantly exceeds the budget. For example, if you budgeted $100,000 for program expenses but spent $150,000, you have a deficit. Alternatively, if you projected $200,000 in donations and received $300,000, that surplus might indicate untapped potential for expanding services or reinvesting in your mission. Spotting these variances early helps you course correct and ensures that your organization stays financially healthy. Regularly comparing actuals to your budget allows for better forecasting and more strategic use of your resources. Now let's jump into revenue recognition. Revenue recognition is one of the most significant areas of weakness that we see in the financial statements for organizations like yours. Revenue recognition errors can be so impactful that they render your financials unreliable, making it difficult to assess your organization's true financial health. Getting revenue recognition wrong doesn't just lead to compliance issues. It can lead to decision-making based on those financials, almost impossible. Revenue recognition is a fundamental principle of accounting designed to reflect the true financial health of your organization. At its core, it ensures that revenue is recorded when it is earned, not when cash is received, aligning income with services provided. This principle is crucial for creating a clear, accurate picture of your organization's performance. It ensures that your financial statements reflect reality rather than short-term cash fluctuations. So why does it matter? First of all, accurate financial reporting. Revenue recognition builds the foundation for accurate financial reporting. By tying revenue to the period when services are provided, you gain a better understanding of your organization's actual financial performance, not just the movement of cash. Secondly, compliance with standards. It also ensures compliance with accounting standards, which are designed to provide consistency and reliability in financial reporting. This is particularly important if your books are subject to a year-end review or audit by an external CPA firm. Third, minimizing audit risks. When revenue is properly recognized, it minimizes the risk of errors during audits. Misstating revenue, either by recognizing it too early or too late, can lead to discrepancies that attract attention during an audit, potentially creating financial or reputational risks. And fourth, informed decision-making. Proper revenue recognition helps executives make more informed decisions. When your financial data aligns with actual operations, it allows for more accurate budgeting, forecasting, and resource allocation. In essence, revenue recognition lays the groundwork for accurate, compliant, and transparent financial management. It aligns your organization's financial reporting with its operational reality, providing a clearer basis for decision-making and accountability. Membership dues. Let's talk about membership dues. By the way, the CSAE Membership Trends Report indicates that respondents to their study had 52.2% of their revenue derived from membership dues. It's an important one. Let's make sure we get it right. When it comes to membership dues, the key is to recognize revenue gradually over the membership period, not all at once. For example, if you receive $12,000 for annual membership, you should recognize $1,000 each month over the 12-month period. Do not record the entire $12,000 upfront when the payment is received. This would misrepresent your revenue and distort your financial statements. By spreading the revenue over the membership term, your financial reporting will better reflect the services provided during each period. Sponsorship and events. For sponsorship and events, it's crucial to recognize revenue only when the event has occurred or when sponsorship conditions have been fully met. For example, if you're hosting an event, you would typically recognize the revenue once the event takes place or once the sponsor's obligations have been fulfilled. Do not record revenue before the event happens or before sponsorship conditions are satisfied. This ensures your financial reports are accurate, reflecting the true timing of the income earned from these activities. For education and development income, it's important to recognize revenue only after the course or service has been delivered. For example, if you receive payment for a course, you should recognize the revenue once the course is completed or the service has been provided. Do not record revenue at the time of payment. If the course or service hasn't been delivered yet, this would misrepresent your financial position. Properly timing the revenue recognition ensures your financial reports accurately reflect the services you've provided. Now, let's move on with strengthening your organization's financial resilience. Strengthening your organization's financial resilience is key to long-term stability and growth. By implementing strategic practices, you can better prepare for financial challenges, manage risks, and create a more sustainable financial foundation. Let's explore some best practices that will help you fortify your organization's financial health and ensure its resilience in changing environments. The first strategy we're going to discuss today is regular financial reviews. Regular financial reviews with your board are an essential strategy for maintaining the financial health of your organization. This involves meeting periodically. Most organizations that we work with do this either monthly or quarterly to review your financial statements, ensuring that your organization's finances are aligned with your strategic goals. These reviews will help you catch potential issues early, allowing for timely adjustments and keeping your financial goals on track. By incorporating regular financial reviews, you can create a proactive approach to managing your organization's financial stability. The next item is maintaining cash reserves. Maintaining cash reserves is a key strategy for financial stability. It involves setting aside usually at least 3 times your monthly operating expenses as reserves to cover unexpected costs. I do say this cautiously, as there are many factors that will go into determining the extent of your cash reserves. For instance, you may be a very cyclical organization or a very seasonal organization, in which case your cash reserves might vary significantly from 3 times the monthly operating expenses that I've proposed here. This strategy provides a financial cushion that allows your organization to handle emergencies or unplanned expenses without disrupting operations. It helps ensure that your organization remains resilient in times of uncertainty or financial strain. An example of when this became really important was at the beginning of COVID, when conferences were canceled and many of the organizations that we work with were in a state of panic and had to dramatically reduce their operations. Many times, the costs, of course, did not correct as quickly as the revenue disappeared. And so this was a situation when maintaining a cash reserve was very critical to our clients. Moving forward, forecasting. Effective forecasting is essential for navigating growth and potential challenges. Many of your organizations are not large enough to have a full-time CFO. So by partnering with a fractional CFO, you gain expert insights to project your organization's future revenue and expenses with accuracy. With a fractional CFO, you can confidently plan ahead, make strategic decisions, and ensure your organization is ready to thrive no matter what the future holds. The next strategy is diversifying revenue streams. This is a conversation that we have frequently with our clients that are so focused on delivering the programs and services that they have in the past. Diversifying revenue streams is a key strategy for reducing financial risk. It involves exploring new sources of income, such as new grants, partnerships, or other funding opportunities to lessen dependency on membership dues. This is one that I often see executive directors and CFOs ignoring. By reducing reliance on a single revenue source, your organization can build a more stable and resilient financial foundation, ensuring greater security in times of change or uncertainty. Let's discuss scenario planning. Scenario planning involves using what-if scenarios to evaluate the potential financial impact of different situations, such as membership drops or event cancellations. To get the most out of scenario planning, it's highly beneficial to work with a senior finance professional like a CFO. Their expertise can help you accurately assess these scenarios, improve your organization's preparedness for financial changes, and mitigate risks before they become serious challenges. And the final item here is to leverage financial technology. Leveraging financial technology is key to improving your organization's financial accuracy and transparency. This strategy involves implementing budgeting and financial tracking tools that provide real-time data. By using these tools, you can enhance your financial tracking processes, making decision-making faster and more efficient. Real-time financial information allows for greater transparency, ensuring your organization stays on top of its financial health, and that it can respond quickly to changes. Now let's switch gears a little bit and talk about building the right financial team. Building the right financial team is essential for your organization's success. Each role, from bookkeepers to controllers and CFOs, bring unique expertise that ensures your finances are managed effectively. Having the right people in place helps you stay compliant, make informed decisions, and drive strategic growth. Let's take a closer look at the key roles you need to build a strong financial foundation for your organization. Let's talk about the role of the bookkeeper. A bookkeeper plays a vital role in managing your organization's day-to-day financial tasks. They handle essential functions such as recording membership dues, invoicing, and reconciling member payments. However, Even with these routine tasks, challenges can arise. Many organizations think that a bookkeeper alone can manage the finances of an association. In smaller organizations, this is often true. That said, the skills of your bookkeeper may vary considerably. We usually find that where challenges can arise is in understanding technical accounting matters, such as revenue recognition, and in working with year-end auditors. This is where you might need to involve a controller. It is usually best to find a bookkeeper who is familiar with your type of organization. All of our bookkeepers at Enkel are trained on the accounting standards relevant to associations and have experience working on the finance side for the not-for-profit sector. Next, we have the role of the controller. A controller plays a critical role in ensuring that your organization complies with the relevant reporting framework. They oversee the preparation of detailed financial statements and manage GST or HST filings, ensuring that your organization stays compliant with all regulations. A controller also conducts deep financial statement reviews, going beyond basic bookkeeping to provide valuable insights into your organization's financial health. These reviews help identify areas of improvement and ensure that your financial data is accurate and ready for board presentations or audits. You should consider hiring a controller when your financial operations become more complex and require professional oversight. Their expertise is key to maintaining accurate, reliable financial reporting and ensuring compliance with nonprofit regulations. Given that many of your organizations would be too small to justify a full-time controller, you can find a controller to assist you on a fractional basis. This can be a valuable way to get the right service level without the full overhead of having this person on your team. You can also find someone who can leverage their experience working with other similar organizations. At Enkel, our controllers will meet with you each month for a structured debrief meeting to highlight potential opportunities and challenges and to ensure that you have the tools to communicate with other stakeholders about your organization's finances. And finally, the role of the CFO. Again, many of your organizations will not need a CFO full-time. A fractional CFO can provide strategic financial oversight for your organization. They focus on long-term financial planning, ensuring that your finances align with your overall mission and goals. Additionally, they handle financial reporting to the board, helping to present complex financial data in a clear and actionable way. You should consider hiring a fractional CFO when your association requires high-level financial strategy, particularly for tasks like budgeting, forecasting, or preparing for important board presentations. Their expertise ensures that your financial decisions are forward-looking and strategically sound, helping your organization stay on course for sustainable growth. We typically find that organizations look to engage a fractional controller when they cross about $2 million in annual operating budget, though I caution against using this as a rule, as organizations may require a CFO for different reasons at different times based on challenges and opportunities that they might be presented with. Our fractional CFOs at Enkel work with clients with budgeting and forecasting, and can help steer organizations financially in times of challenge or crisis. So that's all today in terms of content. We've covered a lot very quickly. A couple things I will say. First of all, please have a look at these guides that we will be making available to you in our follow-up email. These guides will be a great tool to help you start to implement some of the items that we covered today. The first piece of content here is called 10 Strategies for Effective Financial Oversight, Management, and Reporting. And the second one is an NPO's Guide to Working with Enkel. Or if you'd like to discuss further, of course, you can contact us directly. We also look forward to seeing you at the CSAE conference at the end of the month. I will be there the whole time. Come visit us at booth 38. Also, I will be presenting on Friday, November 1st, so please come and learn more from us. I will be diving deeper into some of the matters we discussed today, with a specific focus on how you can strengthen your association's financial resilience in 2025. Now let's jump into Q&A. I'm just going to get queued up here, so it might just take me a minute. Are there any questions? I don't see any coming through at the moment. Oh, here's one. Do you have any recommendations for good courses, training resources for a brand new ED who is very new to reading statements, financial management, and wants to learn the basics herself, not just hire outside help, which I recognize is good too. So I strongly suggest, I think whoever you are, this is a really good question. You should definitely invest some time into understanding how financial statements work. We covered this at a very introductory level today, but there is some really great material out there. I don't actually know of any courses, or nothing's coming to mind outside of courses offered by the Institute of CPAs. You could take a look at those, but I would also encourage you to visit our website. If you go to our content library under not-for-profit organizations, we have done webinars in the past, and we do have ebooks on reading financial statements. So I would encourage you to peruse those documents there. How to improve budgeting, financial donation, and investment. I'm not sure what the question is here. If you are looking for specific information on budgeting, again, you can visit that library. We do, again, have seminars. We do have webinars on this. And I will actually be covering budgeting at the CSAE conference in my session on November 1st. There's a question, should HST be charged on membership for revenue of associations? I am not an HST expert here. There are nuances to HST reporting, so I'm actually not going to respond to this one. I would strongly suggest that you check in with either a controller, or if you don't have a controller on your team, controller or CFO, then I would strongly suggest going to your CPA. I will also say that it does vary by province. Of course, some provinces have HST, others have GST, so would suggest that you get professional assistance there. There's a question as to whether we can help with associations in other provinces. We can work with associations in any province in Canada. So please, if you're interested in working with us, feel free to reach out. Is this overview webinar available for board directors in some variation? Actually, we did do another session quite recently with another organization called Charity Village on the role of the treasurer and the role of the board with respect to financial governance. Sorry, the name escapes me at the moment. You might want to have a look at that one. And there will be more information on this in the piece of downloadable content, the one called 10 Strategies for Effective Financial Oversight, Management, and Reporting. I'm just scrolling through here. I think we have actually covered all of the questions. I did kind of cover those in rapid fire. So if you are interested in chatting with us further, again, please contact us. We will be in contact via email, again, with a recording to this webinar and with links to the downloadable content that I've referenced. Again, we look forward to seeing you at the CSAE conference later this month. Thank you very much for your time and have a great day.